In today's video, we're going to be talking about some of the best ways to invest $10,000 in order to help you get financially free and also build your wealth along the way. So whether you're trying to hit 50K, 100K, or even $1 million, hopefully this list will give you some ideas on how you can invest a sum of 5 figures. For each of the items in today's list, I will also tell you how much risk it carries in my opinion. Now, in a previous video, I said that the number where your life changes the most is actually $10,000. And that's because it's at this amount that everything shifts. When you see your bank account have 5 digits instead of 4, it's proof that you've already built some great habits already. And considering that most Americans can't even afford a $1,000 emergency expense, I think it's a testament to you that you have 10 times that amount saved and ready to invest. So it's important that we build upon the 10K and not risk losing it. The first way to invest $10,000 is to get your financial foundation set in place. The risk level for this investment number 1 is virtually 0. All right. So when I'm talking about a financial foundation, that means you have the basics covered. So this could include something like having your high interest rate debt paid down and also having an emergency fund of at least 3 months of living expenses saved up. If you already have this covered, you might just want to skip ahead in this video to number 2 on the list. However, I still think it's important to go over even if you are a seasoned veteran of personal finance because it's always good to brush up on basics. Having your foundation set should be your highest priority because it can actually be some of the best return on your money. I'm pretty serious about that. It's not sexy or fun, but here's why. Let's say you have credit card debt and the interest rate is 20% on your balance. So when you pay down that credit card balance, it's basically a guaranteed return of 20% on your money. You aren't really going to get 20% return on your money investing in the market, especially at a zero risk level. A broad index fund that tracks the S&P 500 historically returns 8% a year on average, and that's really good already, but it historically returns that, which means that some years will be more, but some years will also be less than 8%. You take a risk by investing in the market because your balance could actually go down. But with paying off high interest rate debt, it's guaranteed that you're going to hit that 20% return as long as you pay that debt off. Now, as to what to classify high interest rate debt as, I would say that any debt over an interest rate of 10% should be paid off immediately. That's usually the sweet spot, and that's what I would classify high interest rate debt. So anything over 10%. Paying off debt, in my opinion, will also free you up mentally. A weight is like lifted off your shoulders, and you'll hopefully be able to operate at a level where you can just make way more money with this new peace of mind. The next part of the financial foundation that I mentioned a little bit earlier is to establish a really strong emergency fund with the $10,000 that you have. Most people suggest 3 months of living expenses saved up. So if your monthly needs cost you about $1,500 per month, your emergency fund target should be around $4,500. Of course, having more is even better, but the 4.5K would be a minimum recommendation. You can even go as high as 6 months or maybe even a 12-month emergency fund. I personally have something between 9 and 12 months saved up. All right, the second way to invest $10,000 today is to invest it in long-term safer holdings that appreciate and are well diversified. And I'm talking about index funds and ETFs. The risk level for this type of investment is going to be between conservative to moderate depending on your age, your goals, and what the ETF actually is. An index fund and often ETFs are basically funds that you can buy on the stock market that are comprised of a portfolio of stocks. So for example, if you buy the S&P 500 index fund, a very popular choice, by buying that one fund, you make one purchase, but you get a small percentage of everything that the index fund owns. So the S&P 500 ETF, ticker symbol VO for example, you're immediately invested into the entire S&P 500 index as a whole, which means that your investment is instantly well diversified among the top 500 companies in the United States. V or VU in the last 5 years is up close to 100%. So if you had put $10,000 into the S&P 500 about 5 years ago, it would now be worth close to $20,000. And as time progresses, your returns should continue to grow over time. Now, an index fund or ETF is a great core investment to hold, and you can do so in a retirement account or a brokerage account. If you're looking for a brokerage account to start your investing, make sure to check out the sponsor of this video, which is Webull. Webull is completely commission-free for stocks and ETFs, which means that when you're buying index funds like VO, you're not paying any commissions that eat into your returns. That's huge when you're doing regular investing over time. The platform gives you access to all the major index fund and ETFs, such as the S&P 500, total market, international funds, and you name it. You can also even buy individual stocks on there as well. Now, here's what really sets Webull apart. The data and research tools are incredible. Before I buy any ETF, I can just do a deep dive into its holdings, performance history, expense ratios, and dividend yields right in the app. The charting tools let you analyze long-term trends, and you can even use their paper trading feature to practice your strategy without risking any real money first. Plus, Webull offers overnight trading 24 hours a day, 5 days a week. So if some news breaks after market hours that might affect your investments, you can actually act on it. And if you want to automate your investing, their Webull Advisors feature can help you build a diversified portfolio based on your goals and risk tolerance. They also have some pretty amazing community features such as something called WeFolio, where you can see what other investors are holding in their portfolios and learn from their strategies. It's like having a financial forum built right into your brokerage app. If you're ready to start building wealth through index fund investing, I definitely recommend checking out Webull. You can use the link in my description to get started, fund your account, and begin building that diversified portfolio that we talked about. You have the ability to earn a cash bonus, a 2% match, and up to an 8.1% APY. So thank you to Webull for sponsoring this portion of the video, and let's continue. The next place to invest $10,000 or part of $10,000 are going to be in individual stocks. Now, the risk level on these varies, but I would say it's somewhere between moderate to higher risk. This approach is exciting because of its potential for higher returns, but there is also downside if you don't get it right. Individual stocks can perform exceptionally well. For example, with Nvidia, anyone who's invested in that company over the past 5 years is up over 1,500% or 15x the return of the S&P 500 on its own. So if you had 10K invested in the S&P 500 over the past 5 years, it would probably be worth close to 20K, but with Nvidia, if you had went Allen, it would be worth well over $150,000 on that same 10K investment. The problem though is that any individual stock on its own can be super volatile, and people that day trade or swing trade aren't always successful. If you are investing in individual stocks and you're a beginner, it's recommended that not only you do tons of research on why you think that company will go up in value over a long-term time horizon, but that you're also diversified enough that even if that one stock goes to zero, it's not going to risk ruining your entire portfolio. For example, let's say you have $10,000 and decide to invest $2,000 each into 5 different companies. If one of those companies goes bankrupt, at least your total portfolio is not down the full 10K. In terms of how to do the research, it helps when you know a little bit or a lot about that said industry that you're investing in. If you know a lot about shipping containers and companies, perhaps looking at stocks in that industry is what you can start with. That's what you want to look for. Intersections of your knowledge and investments that you can identify that others can't. Then you want to make sure that you research the company's earnings reports, perhaps their annual reports. You want to listen to their investor calls, know the leadership, figure out what's on their roadmap, etc. You want to know so much about the company and its competitors in the stock market that you can identify a gap between what the stock is currently trading for and what you think it's actually worth. Warren Buffett's method is to find the intrinsic value of a stock and bet big on stocks in which he thinks where the market just has not realized their full potential yet. I do have some videos on that topic on my channel, or you can just research it online for yourself. The fourth place to invest $10,000 today is a high-yield savings account, a CD, or a treasury bond. All these investments have a very low risk level. Now, you might be thinking to yourself, why would I put my money somewhere that's not going to make me rich? And here's the thing. These investments serve a very specific purpose in your portfolio. They're basically the safety net of your portfolio. And if you don't know what to do with your money, they aren't the worst choice to put your money in because they're paying pretty decent rates right now. Honestly, sometimes I even have up to 20 to 25% of cash in my portfolio, but during those times I do have that much in cash. It's at least sitting in one of these earning me interest. High yield savings accounts right now are currently paying anywhere from 3.5 to 4% APY at many online banks. And that's literally 10 to 15 times what the traditional big banks are paying. On $10,000, that means you would make $350 to $400 a year in a high yield account versus close to nothing at a big bank. CDs, or certificate of deposits, are where you lock up your money for a certain time period. It could be 3 months, 6 months, 1 year, or 2 years. But in exchange for locking that money up, you'll lock in a slightly higher interest rate than a savings account. Right now, a 1-year CD might pay close to 4.1 or 4.2%. So, if you know that you won't need that 10K for a specific period, a CD can be a great way to lock in a guaranteed return. Treasury bonds are basically you lending money to the government. So these come in different maturities. So for example, you might have treasury bills for a short term, like less than 1 year, but there are also treasury notes for 2 to 10 years or even up to 30 years. The way these work is that the government pays you interest for borrowing your money, and at the end of the term, you get your principal back. Right now, you can get treasury bills paying around 4.5%, and longer-term treasuries are paying even more. If you don't want to be locked up that long, you can sell most of the treasuries before they even mature. But that does come with a little bit of risk in case they don't sell for as much as you wanted them to. Treasury bonds are also not as liquid as, say, a high-yield account where you can instantly transfer your money. So with treasuries, you might need a few days to sell and get your cash, and you're taking on some interest rate risk versus a high yield account. You can just pull your cash in and out as you please. Still though, all these 3 investments are very low risk and provide a return and are good for investors who want to sit in cash or are slightly indecisive about their money. The 5th place to invest your $10,000 is riskier or speculative investments. This is especially something you want to pursue perhaps if you're younger, because that's when you should be taking on as much risk as possible to try to grow that money. Now, the risk level for these types of investments is pretty self-explanatory. It's high risk. So let me just preface that conventional wisdom says that index funds are good because they'll average about 8 to 10% per year historically. But if you're trying to get a much higher return, you may want to go for some swings in some high growth stocks, especially in a tax advantage account like the Roth IRA where the capital gains are tax-free. We'll talk more about what exactly speculative investments are, but basically it's when you take a much higher amount of risk, but it's for a lot more upside. If all you have is $10,000, you may not want to allocate your entire 10K into a speculative or high growth stock, but perhaps you can take 10 to 20% of that amount and allocate it in there if you're comfortable with losing that money. I also think that when you start making more of an income, say $100, $200, $250, $500,000 per year, that's when you can start to take some shots at higher conviction plays for bigger gains in your investment account. I'm not saying you should be trying to get rich fast, but sometimes you can get a little boost to your portfolio by finding an undervalued investment in the market and investing in it before the market realizes its true value. Other appreciating assets, for example, are real estate. So oftentimes, if you're able to scoop up some real estate, you can use the power of leverage to increase your returns. So let me give you an example. Pretend at some point in your future wealth building journey, you have $50,000 invested, but you don't think it's growing fast enough. However, you do see a property listed for $250,000. If you bought that property with 20% down, you would spend that entire $50K, yes. But if the property appreciates or goes up, let's say 5% after a year, the property would effectively be worth $262 to $500,000. That means you had an unrealized gain of $12,500 on your initial $50,000 investment. So your return on investment in this case is 25% because of the power of leverage. Even though the home only appreciated 5% because of the loan you took on, you getting a multiplied return. Of course, this is the best case scenario, and of course, you had to take on a loan to do this. If you are trying to get into real estate and cash flowing assets, you want to make sure you do your homework. I'm just simply illustrating to you how the power of leverage works with debt, and that's what many real estate investors are trying to do. Some other high-rises plays that you can get into are simply things like cryptocurrency or perhaps angel investing. However, with those two types of asset classes, it's going to be quite risky. You could lose it all. And oftentimes with angel investing, you could invest in a company and it could go bust, let's say 6 months later on, and then boom, you're out of your entire 10K. I think if you're a beginner and all you have is $10,000, you just want to stick to the safer types of investments on this list. And your whole goal is to just not lose $10,000 because it took you a lot of work to get there. However, with the 10,000 bucks you have many options today. And depending on your risk tolerance, you can choose an option that works best for you. If you're interested in investing in the stock market, you might want to check out my free 50+ minute long tutorial on the stock market for beginners. I will link it right here. It's a great video that answers a bunch of questions. Thanks again to Webull for sponsoring a portion of this video, and I'll see you guys in the next video. All right,